Good morning, everyone. Thanks for joining. I'm Susanna McDermott, Director of Communications at the Interfaith Center on Corporate Responsibility. And on behalf of ICCR's staff and members, we welcome you to this overview of our 2022 Proxy Resolutions and Voting Guide. ICCR's Proxy Guide is an annual compilation of shareholder resolutions filed or co-filed by ICCR members for a given proxy season. We publish the Proxy Guide and are convening this webinar to invite support for these proposals and the environmental, social, and governance concerns they raise. For those of you who may be meeting us for the first time, allow me to take just a couple of minutes to briefly introduce ICCR. Currently celebrating our 50th anniversary year, ICCR is a coalition of over 300 institutional investors representing more than 4 trillion in assets under management. Our members use their collective leverage as shareholders to engage portfolio companies on environmental, social, and governance issues of common concern. Our guiding principle as an organization is that sustainable corporations must look beyond the next earnings report to account for the full impact of their businesses on the environment and society, and must view the well-being of all their stakeholders, including their workers and the communities where they operate, as integral to their long-term success. ICCR's membership comprises a wide spectrum of institutional investors, faith-based organizations, asset management firms, union pension funds, foundations, and other responsible investors. ICCR further launched the Investor Alliance for Human Rights in 2018 to grow the network and build the capacity of investors engaging on business and human rights issues. I think we can all agree that 2021 was a pretty extraordinary year. From the public health and worker rights issues raised by COVID-19 to the manifestations of dire climate predictions around the globe, along with an extremely turbulent political environment here in the US, our members had no shortage of work. Apart from the numerous corporate engagements they manage, investors are also using their collective voice to support regulatory structures designed to foster greater transparency and accountability on the part of companies. And as many of you know, in 2021, ICCR also had to take on the additional challenge of defending shareholder rights by opposing SEC rules implemented during the previous administration, which were designed to thwart shareholders' ability to file proposals. ICCR took the lead in opposing these rules, filing a lawsuit under the Administrative Procedure Act to vacate them, along with allies As You Sow and James McRitchie. It is our hope that this brief overview of our proxy guide will catalyze discussions around ways we can collaborate on issues of common concern, including the protection of shareholder rights. Finally, we are mindful that we don't do this work alone and want to recognize here the significant contributions and support of our many allies and partners, without whom this work simply would not be possible. Just a few housekeeping points before we begin. You will be in listen-only mode throughout the webinar. After speaker remarks, we'll open it up for Q&A, and our speakers will be on the line to answer your questions. Due to the large number of participants, we're asking that you submit your questions through the question box, not the chat box, which you should have at the bottom of your screen. And we encourage you to submit these questions as they come up during the webinar, as opposed to waiting until the very end in order to get your questions in the queue. When typing in your question, please tell us 3 things: your name, organization, and which speaker the question is directed to. Whatever we can't get to on the call today, we promise to follow up on afterwards via email. I want to remind everyone that this webinar is open to the public, and with us today are members of the press. Therefore, all remarks are on the record. Finally, this webinar is being recorded, and a link to the recording, along with a link to the proxy guide, will be sent to all registrants this afternoon. So let's get started. My colleague Julie Wokaty will start us off by taking us through the highlights of this year's proxy guide and calling out some key trends. Afterwards, we'll hear directly from ICCR members about key campaigns they're leading this proxy season. And then, as I said, we'll move to the Q&A. So on to Julie Wokaty, ICCR's Deputy Director of Communications and the principal author of the Proxy Guide, to provide an overview. Julie?
Thank you. Good morning. ICCR began publishing the Proxy Resolutions and Voting Guide in 1974, a few years after our inception. The guide contains the full text of ICCR member-sponsored resolutions, both as lead and co-filer for 2022 corporate proxies as of February 16th. If you are an investor, we invite you to read these proposals and vote your proxies in support of those you can. You'll receive a link to the guide and the recording following today's webinar. So I'll take us through some of the key trends from this year's guide. ICCR's members have filed 436 resolutions at 246 companies. There are a number of noteworthy trends. Despite restrictive changes to Rule 14A8, our members have filed a record-breaking 436 resolutions this year versus 244 at this time last year. While many of our members did increase the number of proposals they filed, a fair portion of this increase is also due to new members joining our ranks. Support for ICCR member resolutions is rising. Last year, 23 proposals, a record number, won majority support. Blackrock supported nearly a third of ICCR member-led proposals that appeared on 2021 proxies, a significant increase from the 5% it supported in 2020. BlackRock's and other large asset managers' support is clearly having an impact on vote outcomes for shareholder proposals, as the number of member-sponsored proposals winning 30% or greater is rising. Last year, half of all member proposals going to a vote reached or surpassed the 30% threshold, a clear increase over 2020, and we expect this trend to continue in 2022. In terms of the issues investors are raising with companies, there are several areas where we are seeing increased focus, and our speakers will be addressing these in their remarks. First, the climate crisis and racial justice dominate investor concerns. Resolutions addressing the climate crisis and racial justice and diversity, equity, and inclusion were the most numerous, with 103 and 100 proposals respectively. Climate-focused proposals are up 88% this year, and racial justice, diversity, equity, and inclusion proposals have increased by 60%. Within the group of climate proposals, those calling for corporations to align their lobbying activities with the goals of the Paris Climate Agreement to reduce global warming to under 1.5 degrees C more than doubled this year. Given the marked success of these proposals last proxy season, this is a clear signal from the investment community that lobbying against climate-forward policies will be challenged. Another group of climate-focused proposals pressed top US banks and insurers to reduce their fossil fuel financing and underwriting. The growth of proposals focused on racial justice is largely due to a group of 32 resolutions calling for companies to conduct racial equity and civil rights audits. The number of proposals in this group more than tripled versus 1 year ago. Based on last year's performance, which saw investors withdraw for agreement at Blackrock and Amgen, with proposals at Amazon and Johnson & Johnson both winning strong votes, we expect 2022 audit proposals to perform very well this year. And as BlackRock's Larry Fink wrote in his 2022 letter to CEOs, no relationship has been more changed by the pandemic than the one between employers and employees. Thus, this year there is a large group of proposals focused on worker rights, tackling a range of issues, including the provision of paid sick leave and a living wage, to employee misclassification, competitive employment standards, employee turnover, freedom of association, and risks from the use of temporary workers. Several called for the inclusion of hourly employee voices on boards of directors. You'll hear more about this group of proposals from our speakers in a bit. And given the unparalleled influence and concentrated control of communications platforms, tech companies can be directly linked to a host of human rights and digital rights harms, including breaches in data privacy and the spreading of misinformation and discrimination harms as a result of algorithms used to collect data, manage content, and target users with advertising. Together with the Investor Alliance, ICCR members sharply ramped up their engagements with the tech sector this year, filing a total of 52 proposals at Meta, Alphabet, Amazon, and Twitter, nearly double the amount filed in 2021. Amazon has challenged 11 of its 18 resolutions with no action requests, while Meta challenged 6 of its 12. Alphabet challenged 5 out of 12 proposals, and Apple 4 of 8. While many of this year's lobbying and spending proposals follow a familiar format with calls for detailed disclosure. Several new resolutions focus more on driving alignment between a company's political activities and its stated core values and public commitments. One area of deep investor concern is the deleterious impacts of corporate political contributions on the health of our democracy, particularly the channeling of corporate funds to politicians and organizations championing voter suppression efforts at the state level. New resolution topics are also up sharply at 25, more than double what we saw last year. New topics include carbon credits, competitive employment standards, and much more. So broadly speaking, where did investor interest coalesce this year? Here we see a breakdown of proposals by issue. So proposals addressing the climate crisis and racial justice and diversity led the way. Governance proposals were the third largest group with 73. Next comes human rights and worker rights with 59, and corporate lobbying and political spending with 55. Environmental health, food sustainability, as well as health equity, both saw 23. There were a number of new topics. These include addressing wealth inequality through an ownership culture, algorithm disclosures, COVID-19 vaccine tech transfer, human rights risks, financialization of housing, and many more. So when shareholders file a resolution, companies may reach out to the filers for a dialogue to discuss aspects of the proposal and find ways to address its requests. If an agreement between both parties is reached that satisfies the main request of the proposal, filers may choose to voluntarily withdraw it. Every year, ICCR members negotiate roughly 100 of these agreements. At the time of publishing, ICCR members had withdrawn 46 resolutions. We expect that number to grow in the next few months and to be consistent with the withdrawal levels seen in 2021. A few of the agreements reached to date were at Apple on right to repair, at Costco on phasing out medically important antibiotics, at Foot Locker on net zero climate targets, at Lowe's on adopting science-based GHG targets, and Tyson on racial equity audits. 82 resolutions, or 19% of all those filed by our members, have been challenged by companies and are being adjudicated at the SEC, versus 62 proposals, or 25% at this time last year. To date, the proposals seeing the most challenges relate to climate change and human rights. In the 30 years since the IPCC first warned the world that greenhouse gases were dangerously warming the global climate, GHG emissions have increased by 60%. In just this past year, we have seen a rapid increase in deadly heat waves, tropical storms, droughts, and sea level rise on every continent. Accordingly, climate-focused resolutions were the most active area of filing. Versus previous years, the climate section of this year's guide is not only exceptionally large, but also very diversified in its asks. There are quite a few new resolutions, including proposals calling for an audited report on the impact of a net zero by 2050 scenario, for a just transition, for a report on external environmental costs, while still others express concern about the use of carbon credits. Minette will discuss this year's resolutions addressing the climate crisis momentarily. ICCR member proposals addressing DEI and racial justice rose 60% versus last season, continuing a 2-year trend. This year, the number of proposals calling for companies to conduct racial equity and civil rights audits, assessing the impacts of their products, services, and overall corporate practices on non-white stakeholders and communities of color more than tripled. Edgar Hernandez will discuss these proposals later in our webinar. There are also several new themes in this section of the guide, including the risks associated with the use of concealment clauses, underwriting police insurance, and the negative impacts of facilities adjacent to communities of color. Sound corporate governance structures serve as the bedrock for healthy long-term financial performance, creating value for all stakeholders. Our members filed 73 governance resolutions, a significant increase due largely to new membership focused on these concerns. In addition to the traditional governance asks, new resolutions ask companies to reincorporate with the deeper purpose, and to report on the externalization of environmental and social costs. 3 additional proposals dealt with consumers' right to repair their own equipment and electronics. Human rights and worker rights related filings were the 4th most active category among our members, with a total of 59 proposals. Even as COVID-19 remains a serious public health threat, government protections meant to safeguard essential workers are already expiring. The Great Resignation and an uptick in unionization efforts illustrate workers' growing frustration. Consequently, this year, there is a significant cluster of resolutions focused on workers' rights issues, ranging from paid sick leave and freedom of association to low wages and racial equity. In a moment, you'll hear from Sarah Couturier-Tanoh about this year's group of freedom of association and competitive employment standards proposals. Another group of resolutions in this section centered on the human rights and digital rights risks inherent in the tech sector. Apple, Google Alphabet, Amazon, Meta, aka Facebook, and Twitter all received multiple resolutions. In addition to ongoing concerns such as the spreading of hate speech and dangerous misinformation on social platforms, the discriminatory implications of facial recognition software, and the failure to curb the proliferation of online child sexual exploitation materials, new tech company resolutions cited data operations and human rights hotspots or conflict zones, and also called for disclosures regarding algorithms that are used to target ads to millions of consumers. Jonas Kron will discuss this year's tech proposals, in particular, an Alphabet proposal on algorithmic harm later in our webinar. Other new human rights resolutions this year included the financialization of housing, i.e. the conversion of single-family homes into rental properties by REITs, and the risk of ghost guns that are readily available for purchase online. Each year, corporations channel millions of dollars to trade associations and political candidates, parties, and committees to influence policy and regulation at state and national levels. Investors are increasingly interested in how these dollars are being deployed and whether or not they are in accord with the company's stated positions and values. At 55, proposals addressing lobbying and political spending were the 5th most popular category this year, more than double the number we saw in the 2021 proxy season. Tech companies all received proposals seeking greater lobbying disclosure. REITs were also highlighted for their impacts on affordable housing. Gig economy giant Uber also received a resolution. And of course, pharma and healthcare companies also once again received a number of lobbying resolutions. There was a greater emphasis this year on the ways corporate political giving is increasingly used to fund the suppression of voting rights, particularly gerrymandering and racist voter suppression in states like Georgia, Texas, and Virginia. Importantly, although more than 60 corporations paused their political donations following the January 6th attack on the US Capitol, many have since resumed these activities at full pace. Managing environmental impacts helps companies compete in a business environment marked by mounting public rejection of corporate overconsumption and waste of precious natural resources. This year's 23 environmental health and food resolutions saw a continuing emphasis on plastic pollution and chemicals of concern, and a new emphasis on the systemic risks of externalizing corporate environmental impacts. Our members filed 23 health resolutions this year, up from last year's 13. The largest group of these focused on equitable access to COVID-19 products, of which 3 call for vaccine technology transfer. 5 additional proposals raised pharma companies' anti-competitive practices, and 3 dealt with public health impacts of junk food sales and obesity. A new group of 4 resolutions dealt with the public health impacts of antimicrobial resistance. And a new resolution dealt with artificial intelligence and implicit bias in healthcare. In a moment, you'll hear more about this year's COVID tech transfer resolutions from Diana Kearney. And now we'll move on to our guest speakers. Thank you.
Terrific. Thank you so much, Julie. Okay, so on to Diana Kearney, Legal and Shareholder Advocacy Advisor at Oxfam America. Diana will discuss this year's resolutions calling for COVID-19 vaccine technology transfer, which would facilitate the sharing of information needed to manufacture vaccines in low and middle income countries where they're needed most. Go ahead, Diana.
Wonderful. Thank you so much, Susanna, and thank you, Julie, for the comprehensive overview. And thank you, everyone, for joining us today. So as Susanna just mentioned, Oxfam and co-filers have filed shareholder proposals at Moderna and Pfizer, asking the companies to study the feasibility of transferring COVID-19 vaccine technology and know-how to manufacturers in low and middle income countries. The company's refusal to transfer mRNA technology is prolonging the pandemic. In addition to creating serious public health consequences, leading to the unnecessary death of millions, it's also creating a massive drag on the global economy. This poses significant risk for investors. The world is now approaching 6 million deaths from COVID-19, including nearly 1 million fatalities in the US alone. The WHO has confirmed that the pandemic could end in 2022 if there's broad vaccine access. But unfortunately, the current state of vaccine inequity is making this unreachable. While 72% of people in high-income states have been fully vaccinated, this figure sinks to 5.5% in low-income countries. As Delta and Omicron have made all too clear, these abysmal numbers provide a breeding ground for more variants to emerge, leading to more lives lost in rich and poor countries alike. Moderna and Pfizer are unable to produce enough vaccines to ensure that everyone has access. Not only are they falling short of their own production targets right now, but their donation-based model is inherently flawed if the goal is to end the pandemic. This isn't just because the companies simply don't have the capacity to manufacture enough on their own, but because the recipient countries are not given enough advanced warning of when they will receive the doses to arrange proper distribution. So donations have been ineffective and they simply don't suffice. This means that transferring mRNA technology to manufacturers who can produce it closer to the recipient population is essential to ending the pandemic. Unfortunately, the companies refuse. Pfizer and Moderna falsely claim that this is because no other capable manufacturers exist. However, Human Rights Watch and researchers at the Imperial College of London have identified over 120 manufacturers in low and middle income states that could manufacture the vaccine now. So this willingness to sacrifice lives for short-term profit not only has consequences for global health, but for the company's long-term investors. And why is that? Well, first, because Moderna and Pfizer are squandering their lead. By refusing to license the mRNA technology to the 120 plus manufacturers in low and middle income countries that could produce the vaccine, other manufacturers are now racing to develop their own mRNA technology. So rather than ensuring they're making profits in the short term by licensing out their technology and remaining industry leaders in 2 to 3 years, Pfizer's and Moderna's short-sighted approach all but guarantees competitors are going to emerge with approved vaccines in 2 to 3 years. So creating competitors in this way comes at the expense of the company's long-term investors. Second, hoarding mRNA technology harms any investor with a diversified portfolio. Leaving vast swaths of the population unvaccinated breathes life into the pandemic, fueling the emergence of variants and dragging down financial markets across the board. The International Chamber of Commerce has warned that the global economy could lose $9.2 trillion if developing economies do not have broad access to COVID-19 vaccines, and that half of these losses will fall on advanced economies. So again, any asset manager with broad holdings should find this alarming. Finally, this public display of extreme greed is posing significant reputational risk. The New York Times is consistently publishing disparaging headlines against both companies, such as Moderna racing for profits keeps vaccine out of reach of poor, while countless outlets have accused Pfizer of bullying low-income governments into accepting grossly unfair contract terms. The company's refusal to share the technology has also been rebuked by members of Congress, mocked by late-night hosts, and so on. So such widespread condemnation has serious implications for the company's brand value and in turn for long-term shareholders. So in sum, given the enormous public health consequences and economic damage that will be wrought by a prolonged pandemic, something that Moderna and Pfizer are uniquely positioned to end, Oxfam and co-filers urge investors to support our call to study the feasibility of transferring mRNA technology to manufacturers worldwide. So thank you all so much again for your time, and we'll be happy to answer questions at the end of the hour. Thanks again.
Thank you, Diana. Okay, next up, Edgar Hernandez, Assistant Director, Strategic Initiatives Department at the Service Employees International Union, otherwise known as SEIU. Edgar will discuss this year's proposals calling on corporations to conduct racial equity audits to develop a comprehensive picture of how they contribute to and could help dismantle systemic racism. Go ahead, Edgar.
Thank you very much, Suzanne. Appreciate it. And first and foremost, on behalf of the SCIU, I want to thank ICCR for this opportunity to recap some of our shareholder activities from 2021 and to discuss the 2022 priorities. Let me just start here by backing up in terms of how we got to this point. As some of you may recall, in the summer of 2020, after the brutal murder of George Floyd, corporations made statements supporting the movement for Black lives. And then after the violent insurrection of January 6th, some companies stopped making political contributions. In light of these events, we decided to file resolutions at companies to conduct racial equity audits so that they can examine their business practices and services that they offer and the impacts that they may have on communities of color. But we also felt that it was important to ask companies to fully disclose their political and lobbying spending in the interest of transparency to ensure that these activities are aligned with shareholder interest. And so for example, we as SCIU last year filed 6 proposals on REAs to conduct REAs, and we're happy to report out that we obtained double-digit support at 4 of the companies that went to a vote. But I'm more proud of the fact that we actually were able to go ahead and get a commitment from Blackrock and Core Civic to agree to conduct the REAs. And so when we went this past shareholder season to refile at some of the companies, we did engage State Street. And after initial conversations last fall, they decided to go ahead and move forward and conduct the REA. So we decided to not file there. So I think it was important for folks to understand that these are proposals that are of interest to investors. In some instances, people felt that this was not something that was going to have traction. But after the shareholder season of last year, and we saw that most, if not all of the shareholder proposals that were filed for conducting REAs received double-digit support, it really showed to investors and the folks in the asset management community that are responsible for conducting and providing votes that these were issues that investors were concerned with. But I also want to note that for us, we did file a proposal on political lobbying at one of the private prison companies, and we were fortunate to receive 67% of shareholder support at the GEO Group. And we say this because we had filed there 2 years before that and got to 42%. So it really demonstrated the level of interest once again by shareholders in terms of trying to make sure that there was transparency and accountability in terms of where people are making their contributions to. And so what we believe is that companies that agree to conduct REAs are able to identify issues and concerns with their business practices and possible services, right, that could possibly lead them to be able to improve their products and services and put them at a competitive advantage over their peers. And so for this particular shareholder season, we're really excited to be part of the group of other shareholder proponents putting forth approximately over 20 proposals this year to ask companies to conduct racial equity and civil rights audit, in addition to political lobbying and political lobbying disclosure resolutions as well. And I think it's important to note that we firmly feel that when we talk about racial equity and justice, that these issues really touch upon the issues of voter suppression. And so when we look at companies, when they're asking us why did we file at some of their institutions, we wanted just to be sure that we understood what is exactly the amount of contributions that folks are making to candidates that could be involved in efforts to suppress people's rights to vote. And to be perfectly honest, in some instances, some of the companies understand that issue. Other instances, they need to maybe take some time to study it a little bit more. But I do think having the conversation is an important piece of the work. And so in conclusion, I would refer to you to the ICCR proxy voting guide for a list of the companies that we filed at. But I would hope that if you do own shares of the companies or we filed some of these resolutions, that we can count on your support in voting for them. Thank you very much.
Great, thanks so much, Edgar. Okay, next we'll hear from Sarah Couturier-Tanoh, Manager of Corporate Engagement and Advocacy at Shareholder Association for Research and Education, otherwise known as SHARE. Sarah will highlight a number of the 2022 worker rights proposals, including a proposal requesting a report on freedom of association at Amazon and a proposal at restaurant brands requesting competitive employment standards. Go ahead, Sarah.
Thank you, Susanna. So it's been years that human capital management is getting more and more attention from institutional investors as they see decent work as a way to mitigate workforce risk, boost productivity, stimulate innovation, meet diversity and equity targets, among other things. And the COVID-19 pandemic has elevated investors' expectations regarding how companies treat their workers and how they incorporate them into the company's long-term strategy planning. The pandemic highlighted the need for companies to see their workforce not as a cost to the business, but rather as an asset in which they should invest. At the onset of the pandemic, it was clear companies that made the decision to prioritize the health and safety and well-being of the workers and their families were in a better position to continue operating. And also, companies that took into account workers' feedback during the pandemic were able to implement appropriate measures to curb the spread while maximizing efficiency. Now that businesses are progressively returning to normality, companies are on a hunt to hire employees, but the labor market is tight in North America due to a high number of job vacancies, and that makes it difficult for many companies to attract and retain skilled employees, especially in the most precarious sectors like the quick service restaurant industry. In normal times, in this industry, the turnover rate is already really high, but now it is worse than ever, and that negatively impacts businesses' ability to operate adequately. A high turnover rate has a lot of implications. For instance, it drives labor costs up because it takes more money to hire new workers and train them than retaining them. It also creates operational disruptions when a restaurant, for instance, does not have enough workers to serve clients. It impacts the service quality, client satisfaction, and profitability. And all of that ultimately threatens shareholders' long-term value. And this risk prompts Chair and our client, the Atkinson Foundation, to file a shareholder proposal at Restaurant Brands International, which own multiple brands like Burger King, Tim Hortons, Popeye, etc. The proposal asks the board to analyze and report on how its business strategy will be resilient in the face of increasing labor market pressure while sustaining shareholders' financial return and long-term value. It is a known fact that this company is facing tremendous challenges to hire workers who prefer to work for other employers who would pay higher wages and provide better benefits. Restaurant Brand International does not help franchisors who operate 95% of the company's restaurants to offer more competitive working conditions. And that puts the company's operation and brand reputation at risk, which could ultimately impact shareholders' long-term value. We engaged the company and filed proposals in the past 3 years, asking for greater human capital management disclosure, and despite strong shareholder support, over 80% of favorable votes from unaffiliated shareholders, the company still refuses to disclose any information about 95% of its workers, those working in franchise restaurants. And the current market dynamic illustrates exactly why investors need workforce metrics and information. I would also like to take a minute to talk about a proposal that we filed at Amazon on behalf of our clients, the Catherine Donnelly Foundation. The proposal asks the board to report on how Amazon's human rights policy and practices align with the ILO Core Convention, especially in regards to freedom of association and right to collective bargaining. In the past years, Amazon continuously undermined workers' ability to organize, form unions, and voice their concerns collectively. And the company's strategy is quite sophisticated and involved surveillance tactics, anti-union consultants, captive meetings, and other clear attempts to interfere with this fundamental right. And these issues have been largely publicized and have been subject to investigations and settlements with public authorities. A report would be useful to help investors understand how Amazon intends to implement its commitment to protect workers' right to association and collective bargaining. Now, both proposals aim at strengthening companies' oversight for human capital management and elevate the standards for decent work practices, including wages, benefit, and health and safety. And we believe this would contribute to the long-term success of both companies. And considering their large employment footprint and the risk associated with poor human capital management practices, we also expect both companies to have a robust board oversight of human capital management, to disclose key workforce performance metrics such as the turnover rate and health and safety metrics, among other things, to help investors assess the risk and progress, and to demonstrate that they incorporate workers' feedback into the decision-making process beyond employees' surveys. Share engaged several companies on human capital management in the past years, and therefore, we urge investors to vote in favor of these proposals. Now, if you have questions on these two proposals, I invite you to write me an email, and I'll be very happy to respond. Thank you. Back to you, Susanna.
Terrific. Thanks so much, Sarah. Okay, on to Jonas Kron, Chief Advocacy Officer at Trillium Asset Management. Jonas will discuss proposals centered on the human and digital rights risks inherent in the tech sector, including this year's proposal at Google Alphabet, highlighting its use of algorithms to target users with advertising. Jonas.
Thank you, and many thanks to ICCR for holding this webinar and for all of you that are participating and taking the time to join. Really appreciate your time. I actually just want to take a step back in time a little bit, back to 1999, when law professor Lawrence Lessig coined a phrase, "code is law." And he used it and provided it really as a useful shorthand to remind us that the choices that the computer system designers make have a profound ability to shape our society. And the prescience of his phrase, I think, is pretty obvious to us now as we regularly see the multitude of ways that decision makers at tech companies can influence so much of our personal lives, our professional lives, and our civic lives. But while we already know how important it is to understand that code is law, I think we're only really beginning to understand its implications in a world where the code being written is for algorithmic systems, artificial intelligence, and machine learning that are really just exponentially more powerful than the pop-up ads of, say, 2001. So for investors, this has a lot of different implications, but one of them is whether algorithmic systems promote fairness, accountability, and transparency. Because understanding this is going to be central to our ability to evaluate their utility and safety to society. But unfortunately, we don't really have enough information about what goes into these systems to be able to judge those social impacts. And that is one of the reasons why Trillium filed this shareholder proposal at Alphabet, asking the company to be more transparent. And actually, it's probably worth just stopping here for a moment and just noting that Trillium is far from alone in filing these kinds of shareholder proposals. You know, we see in the proxy book that there's been a significant increase in the number of shareholder proposals filed at tech companies by investors concerned about the social impacts of tech companies, you know, their human rights policies, their practices, and their performance. What this means is basically we've seen a doubling of proposals in this topic area, and that's, I think, quite notable. Now, a lot of these proposals point out the lack of transparency that creates additional risks for investors. So for example, it makes it harder for investors to evaluate management of regulatory risks. So from proposed laws like the Filter Bubble Transparency Act, the Social Media Disclosure and Transparency of Advertisements Act, the Stop Discrimination by Algorithms Act, and the Digital Services Act. This lack of transparency, it really makes it hard for investors to evaluate how well the company will avoid controversies. So like, for example, the one that Alphabet did not avoid in 2021, when an investigation by the Markup found that Google Ads blocks advertisers from using 83.9% of social and racial justice terms. Similarly, a report by Deloitte recently concluded that increasing complexity, lack of transparency around algorithm design, inappropriate use of algorithms, and weak governance are specific reasons why algorithms are subject to such risks as biases, errors, and other malicious acts. So in our proposal, we point out that regulators in the US and the EU, civil society organizations, and academics are not only asking for more transparency, but importantly, they are also proposing guidelines for how to go about providing that transparency. So given this guidance from organizations like the Mozilla Foundation and researchers at New York University, we actually believe there's a really good roadmap for the tech companies to follow and for investors to be asking the companies to be following. So to sort of pull all this together, because of the lack of transparency about the social and the financial risks created by its reliance on algorithms, investors really need much better disclosures from Alphabet and many other companies. And preferably, those disclosures can fit into the frameworks that are set forth by third-party experts like those at Mozilla and NYU. So for these reasons, we're urging Alphabet shareholders to vote for this proposal at the company AGM, which will happen later this year. And again, thank you very much for your time and very much appreciate it. Thank you.
Great, thanks, Jonas. Okay, and last but most definitely not least, we have Mary Minette, Director of Shareholder Advocacy at Mercy Investment Services, who will discuss ICCR members' wide-ranging proposals to counter the climate crisis. It's a big job. Thanks, Mary.
Thanks, Susanna. So as Julie noted earlier, 2021 was an unprecedented proxy season, with 15 climate-related resolutions gaining majority votes at annual meetings and higher votes overall. The average vote on climate-related proposals was about 41%. In addition, 2021 saw an epic proxy battle at oil major ExxonMobil, which resulted in the election of 3 directors from engine number one's alternative slate to the board, in large part due to concerns over the company's handling of climate matters. The 2022 proxy season has the potential to be just as interesting for climate-related issues and proposals. 6 of last year's majority votes concerned how companies were managing their climate lobbying activities, both direct and through trade associations. ICCR investors are leading 21 proposals this year, asking companies to issue reports on how they ensure that their lobbying activities align with the goals of the Paris Climate Agreement. We expect that companies will negotiate withdrawals of some of these, but one likely to go to a vote was filed by Mercy and other investors at UPS. Although UPS reports some of its memberships in trade associations, it gives little detail about how the board is involved in membership decisions or how the company might consider what actions to take if one of its trade associations is lobbying against the goals of the Paris Agreement. This alignment is important because UPS has set a goal of becoming carbon neutral by 2050 and doing the difficult work to transition its delivery trucks and airplanes to lower carbon energy sources, a transition that requires supportive public policies. Many ICCR members have also filed proposals asking companies to set science-based greenhouse gas targets this proxy season, an indication of both the growing focus on long-term corporate plans to address climate risk and changes in how the SEC views requests for such targets. Mercy and other ICCR investors have filed a proposal with US refiner Valero Energy, asking the company to report not only their emissions from operations and purchased electricity, scopes 1 and 2, but also their substantial scope 3 emissions from the use of their fossil fuel products, which the company does not currently report. The proposal also asks this company to set short, medium, and long-term goals for reducing all emissions. Similar proposals last year at Phillips 66, ConocoPhillips, and Chevron received majority votes. Fellow refiner Phillips 66 has since disclosed its scope 3 emissions and set a target, and Marathon Petroleum announced a scope 3 target just this week. The largest US banking institutions are a significant source of funding for oil and gas companies and utilities that develop and use fossil fuels. In 2020 and 2021, due to strong investor pressure, the largest US banks made pledges to reduce their emissions, the emissions of their lending portfolios, with the goal of reaching net zero by 2050. This year, ICCR investors are asking those banks to consider setting policies that constrain lending to new fossil fuel exploration and development in line with a new scenario published by the International Energy Agency in 2021. The IEA net zero scenario noted that to keep global temperature rise within 1.5 degrees Celsius, development of new fossil fuel production and new coal-fired power generation would need to stop immediately. Mercy co-lead John Harrington and other investors have filed a proposal at JPMorgan Chase asking the bank, the world's leading financier of fossil fuel projects and companies, to adopt a no fossil fuels policy. A last category of proposals asks companies to issue an audited report to shareholders on how a significant reduction in fossil fuel use, in line with the IEA net zero scenario, would affect their financial position and underlying assumptions like commodity pricing and asset valuation. Filed last year for the first time at ExxonMobil and Chevron, the proposal achieved near majority votes. This year, investors have filed versions of this proposal at a variety of oil and gas companies and utilities, including a refiling at ExxonMobil by Christian Brothers Investment Services and a proposal filed by Mercy and other investors at Duke Energy. Duke plans to reach net zero by 2050 and recently announced that it will include upstream and downstream emissions from the natural gas used for power generation and in its gas distribution business in its long-term target. However, the company has not disclosed details of how its net zero plans will impact the assumptions that underlie its financial statements, including those related to its natural gas assets. Climate change presents a systemic risk for companies and investors alike. The climate proposals filed this year by Mercy and other ICCR members are aimed at improving climate governance, mitigating climate risk, and encouraging climate action. We urge your support. Thank you.
Thanks so much, Mary, and thanks to all of our speakers for your remarks. We're going to move on now to the Q&A. Again, just a reminder to put your questions, and many of you are already putting them in the Q&A box, not the chat box, because I won't be monitoring that as well. So I'm going to start off. Our first question is from Lindsay Frost of Agenda Week. And I'm going to throw this one out to everyone. Do ICCR members engage with large asset managers such as Blackrock to push for support for proposals? Do they have an idea of whether these big firms will support proposals ahead of time? Whoever wants to take that up.
Yeah, so I just wanted to go ahead and say that we actually had our first engagement with Vanguard last 2 weeks in terms of some of our shareholder priorities. And we did put forth the case in terms of why we felt that some of the proposals we filed merited their support. So that's just one example. And I'll be honest, this is the first time we've had that experience with Blackrock. So we are actively looking for opportunities to go ahead and talk to other large asset managers to make sure that they understand why we are putting forth these proposals.
Any others want to jump in on conversations with Blackrock? I know they happen.
Yeah,
Lindsay, go ahead.
Just to say that we do try to reach out to large asset managers, public pension funds, proxy advisory firms to sort of explain why there's a financial harm for long-term investors. We do not know usually in advance whether or not those asset managers are going to support our proposals. We usually don't find out until following the AGM.
Great, thanks, Diana. Here's another question from Lindsay. Do ICCR members find board directors more willing to directly engage on these issues, or do the companies typically offer management to engage?
I guess I'll jump in on that one. I guess I'll give the lawyerly answer. It depends. Sometimes they do and sometimes they don't. It really, I think, depends on the issue. It depends on the company. We've certainly found in many occasions leadership of the board, whether that's the chair of the board or the lead independent director or perhaps the relevant committee, ready, willing, and able to meet. But many times it's more appropriate for the management to be engaging. I think it really depends on the company and their own practices and the topics. But I would say that companies are proving themselves, I think, year after year after year, much quicker to pick up the phone and be eager to have a conversation about the concerns that we're bringing to them. I think they really understand this is a rare company at this point that just dismisses an environmental concern or a social concern out of hand. I think for the most part, they're really starting to understand that they need to actively and positively engage with their shareholders.
Great. Thanks, Jonas. This is a question for you, Edgar, actually from Andy Jones, and a very similar question from Frank Sherman. Is there any recent guidance on good practices or good examples for a racial equity audit that you can offer?
Yeah, so it's interesting because there's actually been 3 such type audits that have already been conducted, right? At Airbnb and at Starbucks, and Facebook as well, right? So there's those reports already out there. And if I had to pick my preference, I would say that Starbucks is the one that I actually look towards in terms of just some of the guidance in terms of how they conducted the audit, who conducted the audit, and possible next steps as well. So I think that's part of the process. But I also know that in working collaboratively with the folks at the SOC Investment Group, we actually put forth a Q&A questionnaire, Q&A document that actually answers a lot of questions for folks that may be interested in learning more about what it takes to conduct a racial equity audit and what are some of the questions they should be asking. And in addition to that, there was a follow-up document that also was created to help people understand what are some of the terms of settlement that they may be looking at exploring if they get to a point where they feel that they can engage a company on those kinds of conversations. So I do think that those are the three firms that I would put forth. But also at the same time, because there's so many proposals that have been filed now, and that some of the REAs and civil rights audits are now underway at certain companies, that there may be new opportunities for folks to consider in terms of what they're looking at conducting going forward as well.
Edgar, let me stick with you for one moment. It's a question from Charlotte Apps. How do you select which companies to target for resolutions, given that many are falling short of expectations with regard to racial equity?
Yeah, so I think first and foremost, I don't think I found a company that has actually hit like all the metrics in terms of just, doing all the things that they can to address racial justice and racial equity at their companies. So we feel that every company that we own shares of is a potential target. And at the same time, when we found that some companies that have done more than others, in some instances, they do get a bit surprised or maybe even offended that we're actually asking them to provide how successful that they've been in terms of making sure that they're doing things that could be moving the needle in the right direction. But we always say we're not singling you out. We're just asking you to have this process to be put forth so that you can better assess whether you're making progress or not. Because I think it's important for us to put a mirror in front of our face so that we know exactly whether we're being successful in trying to achieve these goals. And if not, what is it that we can be doing to make things, change things up to make things better? Because I think overall, this is 2022, right? And we've yet to see, there's still a lot of work to be done. So I do think that, when we put forth these proposals, people should not be offended by them, and they should just look at it as an opportunity to engage in this conversation and see what's possible going forward.
Great, thanks. Okay, Jonas, I think this is for you. There's current debate about members of Congress, their personal investments in tech giants, which are significant, and oil and gas. What to do as the debate about this goes on, and can we expect new guidelines or rules for Senate and House members and what they invest in, and also addressed through legislation? Many of these investments work against societal interests.
So let's see, I guess not exactly in the shareholder proposal realm, but what I would say is that I think that the concern around members of Congress and their trading of shares has been getting more and more, the concerns around have been increasing pretty steadily. And I think we're starting to see an openness from some key members of Congress to regulating that and stopping those kind of transactions. There has been actually a surprising amount of legislation passed in the last few weeks, which I think probably surprises most folks. There seems to be a little bit of wave of progress, and so this may be part of that wave, and we actually will see some developments there.
Okay, great, thanks. Mary, a climate question. So regarding climate and carbon footprint, how do you solve for quality controlling disclosure data when a company agrees on transparency? Is that part of the negotiation, how to calculate this data?
Typically not. I mean, it really depends on the industry. There are definitely some standards out there for how to do it, and there are credible sort of third-party resources to certify results. And we tend to ask, that the companies do that. It is a best practice. But, just getting a company in some cases to agree to even start thinking about setting a target is a big deal. We are seeing an increasing number of proposals specifically asking for science-based targets. And there is an organization called the Science-Based Targets Initiative, which will certify that the target is doing what it says it's going to do. But one of the roles of investors going forward, I think, is going to be making sure that companies really are adhering to those plans. And that's sort of the nature of the job as investors. We have to hold their feet to the fire over time.
Okay, Mary, just hang there for 1 second. Another question here. There's no accountability. This is from Dennis Tudor. There's no accountability for not meeting net zero targets. For instance, a Sarbanes-Oxley kind of accountability. Are you pushing lawmakers, so this is around policy advocacy, for regulations as well? Otherwise, all of these targets seem aspirational.
Good question. One of the things that I think a lot of investors are looking to is the SEC for some clarity on disclosures around net zero targets and targets generally, and disclosures around emissions and things like that. I think once we get some ground rules, it will be easier to make sure that there is that accountability. The Science Based Targets Initiative, again, has a new net zero pathway that they're pushing out there that we are encouraging more and more companies to use. But yes, there are definitely some net zero pledges out there that are nothing more than the paper that they're printed on at this point. And really that is going to be our job going forward, is to make sure that they do become real.
Good. Okay, this is kind of for everyone. From Nancy Cohn, do any of the proposals address the obscene salary disparities of corporate directors compared to workers and the lack of racial diversity in higher management? I don't know, Sarah, if you feel maybe that's for you.
No, that's a good question. None of our proposal directly address this issue. However, when we discuss with member of the management team or board, we ask when appropriate that these companies link ESG performances and compensations. And we also ask for a stronger board oversight, but we haven't filed any proposal on pay disparities more specifically.
If I could also maybe just jump in, one of the things about CEO pay and director pay, well, not so much with director pay, with CEO pay, is that every year most of us have an opportunity to vote on that. We have management standard pay proposals, and at Trillium for a number of years, we've actually built pay disparities into our proxy voting guidelines, and I think it's something that is probably long overdue for folks to consider, is how they will incorporate the information that we already have about the pay disparity between the CEO and the median worker, and to actually start using that in decisions about whether to support a pay package or not. Unfortunately, most pay packages are getting 90, 95, 98% support. That's starting to kind of looks like a Soviet election. But there are those marginal cases where it really can make a difference, where we saw at Nike recently that the pay package, I think, got just over 50% of support. And so there are these cases where it really can make a difference, and not only relying on shareholder proposals as a way to advance this, but the voting that we're all going to be doing this spring is really a great opportunity.
Great, thanks, Jonas. I think there's one question, time for one more. This is from Dennis Sadowski of Catholic News Service. Hi, Dennis. To Edgar and anyone else, what has been the response from corporate leaders to challenges and political contributions to candidates that are supporting voter restrictions and gerrymandering to reduce the influence of people of color? How do they defend these contributions? Do these steps to restrict boost their bottom line?
That's a great question. And I think our experience has been that they're really quick to point out that in most instances, they've not made direct contributions, or their contributions have been very minimal, $500, $1,000, or whatever the case may be. And I think because they understand the headline risk associated with that, but at the same time, when we ask, what are they doing in terms of their 501c4 and C6, the trade association, and other types of contributions, the dark money, that's when they start hemming and hawing. Well, we're a part of this association because it really helps us move this forward. And I think that's where they're really wrestling with the issue as it relates to full transparency and disclosure in terms of who they are contributing monies to. And I think that's just been the majority of the companies that we've had the opportunity to engage with recently, with one exception. There was this one company I cannot name at this moment, but they pretty much told us to go jump in the lake. That if we felt that we knew how to run the company, that we would be doing so ourselves. And that really took us back, because we felt that we had an opportunity to have a productive conversation with these folks, but it just turned out to be total opposite. So I would say, in terms of just the overall reception, people have understood the concerns. They're wrestling with the issue, but at the same time, we've yet to see anyone move in a direction where they're going to have full disclosure of all the donations. In my belief, any donation that is made, whether it's $1 to 7 figures, should be disclosed. Not because any of the folks, are going to do anything with the information, but I just think that sunshine's the best disinfectant.
Amen. Okay, there are so many great questions, folks. I'm going to capture all of these and send them on. But congratulations and many, many thanks to all of our speakers, to Jonas, Mary, Edgar, Sarah, and Diana, who did such an outstanding job. And of course, my partner, Julie, for doing a terrific job with the book. Again, the link to the book and the link to the recording of this webinar will be available this afternoon. We just have to do some downloading and uploading, and we will send that to all of the registrants a little bit later today. Again, thank you all for joining us today, and remember to vote your proxies. Okay, take care, everyone. Have a wonderful day. Be well.